Good morning, everybody. Hopefully you had a wonderful weekend. I have lots of good news if you're doing things right today. So you're going to be a very happy camper if you're doing things right, and hopefully if you're not doing things right, it'll be a wake-up call. So let's go ahead and get started with that. Let's see here. First thing as always, make sure you're doing those 5-minute moneymakers. Last week's was want to learn how to write a great bio for yourself. So I gave you two resources to write great bios for yourself. So you should always have a long and a short bio. For when you're doing press releases, for when you're on your website, when you're doing marketing, etc. So make sure if you do not have a good bio that you take, well, even if you think you have a good bio, check those out and then compare what you have with what they recommend. And then the tape breakdown was you got to start out on the right foot, listen to 45-second snippet from the beginning of a 21-point checklist and tell me what you think is going on in the minds of the client. So guys, what they found now is that you can, and you're going to see a 5-minute moneymaker pretty soon on this, but let me get some answers to this. How quickly do you think people make a decision about you? How quickly do you think people make a decision about you? Give me actual times. 30 seconds is one, a minute. 5 seconds, 3 seconds, first 10 seconds, 20 seconds. So we get them all sorts. So 3 seconds, actually what they found, and again, you'll see here in a 5-minute moneymaker here in the next couple of weeks that it actually is less than a second they're going to make a decision about whether they can trust you or not. Now, they've made that decision. You can unwind that a little bit, but man, when they make a decision that quickly, guess what? We don't have a lot of wiggle room to make any mistakes early in the meeting. So let me ask a quick question on this. This is something I ask people all the time. So what are the 3 times, and this is extra, I don't even have it in the slideshow here, but when are the 3 times that we want to use empowering? So we've got, remember we have APE, agree, parrot, and empower. What are the 3 times we absolutely want to empower people? What are the 3 times? As soon as possible, Michael's got it. So first one is you want to do it as soon as possible. You want to empower them. Find some reason to tell them they're above average. That's right, Jerry, at the very beginning, because if you tell them at the very beginning that they are above average, you're depositing positive energy in the bank, because we know we're going to make a mistake. We know we're going to make a mistake. So if you have positive energy in the bank where they like you already because you've already told them they're above average, and people love to be around people who tell them they're above average, it's going to give you more wiggle room to make mistakes. And then Daniel, you came up with the second reason, which is if you feel like something went wrong, if you feel something went wrong where you corrected them, or you overspoke them, or you didn't acknowledge or didn't laugh at their joke. So if you feel like you've done something wrong, or the meeting is getting a little rough around the edges, look for a moment to empower them, because it'll smooth off those rough edges. So number 1, as early in the meeting as possible to deposit some good energy in the bank. Number 2 is when you feel like you've done something wrong or the meeting's getting a little bit rough. And then the third point, very good, Tom. Tom's got the third one, which is when they make a point for you, a significant point for you. When they get the motive, jump to the motive for us, man, I'm going to empower them like a son of a gun. If they make a major point for us, I'm going to empower them like a son of a gun, because they cannot back down from that point then. Because once they've made that point for us, and then so a little point, I'm not going to empower them. But a major point, yes. A moral of the story, yes. I'm going to empower them, because then once they've said it, we've empowered them for it, what can they not do, guys? If they've said something and I say, man, you're so smart, I can't believe you're above average, nobody gets that, you got it, well, I can't take it back, Jonathan, right, Nicholas and Jonathan? So that's just a little side. Those are the 3 times you want to empower. And do you all know where to find empowering on the website, examples of how you empower on the website? Do you all know where to find that? Does anybody not know where to find that, or do you want me to show that to you? Just so you know where it's at? Everybody, I guess everybody knows where it is? Okay, good. So this moment is an opportunity. Oh, now I'm getting people say show where it is. Okay, just a second here. So it doesn't take that long. So let me go to the website. Come on, baby. So if we go down to library, audio video school, and Help me, Missy. You're my last hope.
I'm just looking right now, actually.
I just showed it to somebody on Friday.
Right there. Example of empowering. Oh, shoot. It just jumped. Scroll up just a little bit. Then the last. Keep going up a little bit more. Right there. It's at the top of the page now. Right underneath disclosure meeting 21. Example of empowering audio 151.
Ah, there you go, guys. Disclosure meeting. Example of empowering. So it's I go on and on and on for a minute and 51 seconds empowering. So you don't need to do it that way, but it gives you lots of different phrases that you can use in your empowering skills. And how good should you be? I want everybody to answer this. How good should you be at empowering people? For those of you that, and then not only that, anybody who on the call who has had experience empowering somebody, tell me, shoot me a little blurb about how well that works. So I'm getting a lot. You better be great. You better be awesome. Yeah, now I'm getting people say, man, this works flawlessly. It's golden. Okay, so make sure that you're good at that. Okay, so let me get out of here. So this is a moment that's presenting a huge opportunity. So what is that moment? Well, we have this movie that came out this weekend. So in 2049, that's what the world is going to look like. So that's an exaggeration, but are we living in a changing world? Obviously we are. But let's talk about not only is the world changing, but how about our little microcosm of a world? Is the world that we work in different? Is it changing? Or is it the same as it was 10 years ago, 20 years ago? Is it even the same as it was 5 years ago? So Deloitte actually put out a white paper on the 10 disruptive trends in wealth management. So let me ask you a question. Does Deloitte have any sort of agenda? Does Deloitte have any sort of leaning towards they want people to sell more securities, they want people to sell more fixed stuff, they want people to sell anything, or are they just simply a consultative firm? Jonathan saying it's an accounting firm. I want everybody to agree on this. So do they have any sort of agenda other than to get people to hire them as a consulting firm? I mean, people are hiring them for what? Biased or unbiased information? Come on, guys. I have two answers. I'm going to need everybody to answer this. It's like anything. So it's like with our clients. Can we move on from Morningstar unless you agree that Morningstar is unbiased? So I got 5, 10 unbiased. Come on, keep going. Okay, so good. They're third party, unbiased. Everybody's typing that in now. Good. So here's what they found. The 10 disruptive trends in wealth management. Big changes are coming, obviously, they said. And one of the big changes, or one that turns into many changes, is the financial marketplace, the new investment environment. There's going to be challenges for potential issuers and intermediaries. So we're seeing new highs and new lows when it comes to investing. First of all, we're seeing low interest rates. How do low interest rates affect us and our clients? Well, I don't know if you remember, my grandma when she retired, she put all of her money in CDs, and what kind of interest rate was she making? She's making 8% on her CD, so could she live on that? No. That's right, Gregory. We have to take more risk for yield. So you can't just put it in the bank making 8% anymore. So the new low interest rates, is it allowing people to when they retire, be heavily invested in guaranteed things? No. And there's a double whammy here. Any idiot that's putting his clients into bonds right now, what's he doing to his clients? Unless they're in 2 or 3 year maturity bonds, what's he signing his clients up for? Guys, when I worked at Wells Fargo, geez Louise, I didn't start out at Wells Fargo. I was hired at a bank, and then they were bought by Wells Fargo. But I basically sold bonds for 2 years. I sold bonds for 2 years. And dudes, do you think when I sold bonds, do you ever think I saw a client lose 30% on their bonds? And it wasn't because of credit default. Do you ever think I saw a client lose 30% on bonds? Man, talk about a lesson. Jerry, you are incorrect. Yes, I saw a client lose 30% on bonds. I saw several clients lose 30% on bonds. Why? Because as interest rates go up, what happens to bonds? And dudes, when you start to handle calls, because why do people buy bonds? Why do people buy bonds? They think they're what? Safe. They think that, well, they're for income, but the reason they do it is because they think they're safe. Because otherwise, if they wanted income, can you make more on a dividend-paying stock or on a bond today? Because if they really wanted, income, will you make more on a income-paying stock or on a bond today? Stock. So they're not buying it for income. They're buying it for what? Safety. So when they get their statement, and does the statement ever say, "Hey, hold on to maturity, and you'll get your value back"? No. What's the statement show? Your bond sucks wind. That's what it shows. So are interest rates really going to go down any lower, guys? Do you really think we're coming up on that. So there's only one way for your bonds to go. And for you to sit there and believe me trying to explain to a client not to worry when their statement's saying that their bonds are down 20% and 30%, that if they just hold on to the long run, guess how great that conversation was? And I'll be straight with you. Guess what happened to those clients? Guess what happened to those clients? Yeah, they left, Dave. That's right, Nicholas. They left. They bye-bye. So, dudes, where do we put our clients' guaranteed money? FIAs. FIAs have beaten the stock market for the last 16, 17 years. That's not why we invest in FIAs, though. We invest as what? The growth part or the guaranteed part? But if the guaranteed part beat the growth part, dude, what kind of idiot would have their client's guaranteed money in a bond right now? Unless you're in a 2 or 3 year bond. Just help me out, guys. What are 2 or 3 year bonds paying? Why don't you just give your clients a kick in the nuts? I mean, why else? Why else would you want it? I mean, they're not paying anything. So low inflation rates. What's bad with the low inflation rates? What's causing us to rethink our financial and real asset appreciation? Because right now, we've seen the market do great, but how long can the market do so much better than the growth of the country? Can stocks continue to outpace the GDP? No, that is not the way the world works. If it was, right, if that's the way the world worked, how much would stocks be ahead of the market, or of the economy right now? Because if every single year for the last 100 years stocks have outpaced the economy, how much further would stocks be ahead? What would the earnings per share ratio be right now if it was typical for stocks to outpace the economy for the last 100 years? Where would stocks be right now as compared to the economy? What would the earnings per share ratio be? So Jeff, can you explain that in a different way, Jeff?
Well, I think that's the right question. I mean,
nobody's answering it. So they're either frightened to beat the band or don't agree or something. So try to explain it in a different way.
Well, if stocks were more valuable than companies, then what would happen to companies? I mean, how many companies, why would anybody do any work? Why would IBM bother to produce computers? Why wouldn't they just invest in their own stock?
That's a great analogy. That's absolutely a different way of looking at it, and it makes total sense. Guys, there has to be some relationship to the profitability of a company, the profitability of an economy, to the stocks. So if we have low inflation rate right now, low growth, guess what? And right now, stocks have been going like gangbusters. That means eventually we have what? A return to what? A return to what, guys? A return to mean, right, Dave? Return to normalcy. And here's the thing that really scares me, so I put it in red. Why does this scare me so much? The Fed has virtually no ammunition to bail out a failing market or economy. Why do I say it has no ammunition to bail out the market or economy? Yeah, interest rates are so low, Gregory. Can they lower them anymore? Can they lower interest anymore? They blew their wad already, so they can't do anything. I mean, at least when we had the Great Recession in 2007, 2008, they're able to lower interest rates by buying huge and huge amounts of bonds. Can they do that any further? Are they out of ammunition? This is scary. Because when we have a hiccup, and do you think we're never going to have a hiccup, guys? Do you think that, for the next 10 years, no hiccups? Next 5 years, no hiccups? So when it happens, the Fed has no way to, so that means how long will recovery be? The recovery is going to be excessively long. Oops, let me get to the next step. Low and slow rates of economic growth, we've talked about that. High volatility, challenging long-held beliefs in the wisdom of diversification and market timing. This is again Deloitte saying what about diversification? Deloitte saying what about diversification? It's not going to help, right, Gregory? It's not going to help. And high levels of financial leverage. You guys all remember this slide that I showed you? So, this is Bitcoin. This is silver as compared to Bitcoin. This is the world's richest people compared to silver. This is the world's biggest companies compared to the world's biggest people, or richest people, silver and Bitcoin. Let's keep going down here. This is the Federal Reserve balance sheet compared to the biggest companies. This is the coins and banknotes. This is the cash that's in the marketplace right now compared to the balance sheet. This is commercial real estate compared to these things. This is gold compared to commercial real estate. This is narrow money, which is, according to the CIA fact book, is the total value of the world's easily accessible money. Here's the stock market as compared to that. Okay. Here's broad money, which according to the CIA is the total value of the world's money, not easily accessible, but all the world's money. So you see we're getting bigger. Here's the global debt. Okay, so how's that compared to the marketplace? How's that compared to all the money available right now? How's that compared to all, let's go see, look at that compared to all the value of all the companies. Commercial real estate companies. I mean, look at that. Okay, what am I not talking about yet? What am I not talking about yet? Leverage, Gregory. Now let's look at derivatives. Here we go. Here we go. Here we go. Still going. 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 Still go. Guys, is that more or less than what we had in derivatives in 2000, 2008? More or less? A little more or a lot more? If you're managing somebody's assets and that doesn't scare the bejesus out of you, I don't know what will. So because of all of these things, advisors will have to factor in far more what-if scenarios. Do we deal with what-if scenarios with our clients? Oh, somebody wants to see, Gregory wants to see that link again, sure. Well, if you just go to type in this. Here's all the money in the world in one chart. Just type in that. Here's all the money in the world in one chart, and that'll bring you. You'll find it on Google. Okay. Oops. Let me get out of here. Back to this. So because of these things, advisors will have to factor in far more what-if scenarios. Guys, where do we actually ask the clients this? Does anybody know? When we ask the clients the 5 things they're looking for in investment, what's the last question we ask them? Should we be prepared for what? The good, the bad, or both? If we say the good, bad, or both, are there any other what-if scenarios that we're not covering when we say good, bad, or both? So do we cover all the what-if scenarios when we say, should we be prepared for the good, the bad, or both? So are we doing what Deloitte says we should be doing? Second one, be proactive in times of volatility. Are we proactive in times of volatility? Yes, because when our clients have a 50-50 portfolio, have we been proactive by setting up with at least half their money in something that's guaranteed? Develop new strategies that show value beyond just growth. How do we do this, guys? Develop new strategies that show value beyond growth. How do we do that? Nicholas has got it. Let's see more. How do we show value beyond just growth? Oh, okay. So I've got people saying the 21, and then Dave says the sale or trip. Yeah. So the thing we're doing is we're providing, showing them we're not just growth oriented. We're what? We're holistic. We're holistic. Develop strategies that will quickly unlock long positions and move into defensive positions. What do we have that quickly unlocks long positions and moves into defensive positions? Wade's got it. Everybody's getting it. The FIA. Why does the FIA quickly unlock long positions? Guys, as soon as the market starts going up, what does the FIA do? The instant the market starts going up, what does the FIA do? Goes up. And as soon as the market starts going down, what does the FIA do? It's out. It has 20/20 hindsight. Do you know any money manager that has 20/20 hindsight that can change things based on what happened last year? Is there any money manager out there that can change things based on what happened last year? No. Well, yeah, F squared. And what happened to F squared, John? What happened to F squared, John? Yeah, they're gone. So they used 20/20 hindsight. They never actually had any people's monies in those portfolios, but they showed how great they would have worked otherwise. Because all they did was, it'd be like somebody putting all their money, showing a portfolio with 5-star Morningstar funds. I had that happen once. I said, holy crap, how did that client have all their money in 5-star Morningstar funds? They've killed it over the last 5 years. Well, guess what I found out? Were they in those funds for the last 5 years? No. They just got into them. And we found out what's likely to happen to those, the funds that have done, we talked about this last week, the funds that did so well last year, they're likely to do what this year? Go down. Allow investors to place bets on macro trends and indices. Are we doing that with FIAs, guys? While protecting the guys, it's like I hired Deloitte to write this for us. It's almost like I hired Deloitte. Can you write an advertisement for FIAs? Do you get that? Hedge and risk management will be at a premium. Do we do that with the 50-50 portfolio? More than 2 yeses, guys. I need more than 2 yeses. Do you see? I mean, this is what they're saying. Advisors had better do these things. Do we do things at 21 with the 21-point checklist with our 50-50 portfolio with FIAs in their portfolios? How many of your competitors could answer yes to all these things? How many of your competitors could answer yes to all these things? None. None, none, none. Now, why is this important? Like I said, that's not the good news. That's all the stuff you better be. Well, the good news is, hey, you know what? You have everything you need with 5Q, according to Deloitte Touche. But that's not the really, really good news. There's something very important that's happening right now. So is this cat going up or going down? Because is this cat going up or going down? The reason I ask that is because we got something that's going up and going down. What it is we are about to witness the biggest wealth transfer in history at the very time. I said, we are about to witness the biggest wealth transfer in history. At least some of us are. What do we mean by at least some of us are? What does it mean at least some of us are? Well, here's what it means. 1/3 of all financial advisors, about half of financial advisors are over age 56. About half of advisors are over age 56. So Deloitte says that 1/3 of all financial advisors will retire in the next 10 years. So is that an opportunity, guys? Heck yeah. And well, you hit it on the head, Dave. I'm not going to get there in a second. The second thing is 58 trillion. 58 trillion with a T is going to move from one generation to the next in the coming decades. So I'll give you an example of that. Guess how many years it took for, guess how much money right now is in variable annuities? All the money combined together in variable annuities. $1 trillion. Wade's saying 3 trillion. I've heard 1 trillion. But even if it's 3 trillion, how does this compare to 58 trillion? So that means how many times, 10, 15 times more money is going to be moving from one generation to the next in the coming decades than it's on all variable annuities right now. Is that a good opportunity or a bad opportunity? It's a huge. So at the very time advisors are leaving, money's going to be moving, and it gets even better, guys. It gets even better. Advisors are retiring. Wirehouse and BDs are finding it difficult to find new advisors. And that means that the third of the advisors that are leaving, are they going to be replaced, or is there going to be less advisors for more money? Less. And they're losing the ones they have to RIAs. And here's the funny thing, guys. Those of you still working with BDs, in the last 5 years, we probably, Jeff and I probably helped 90 guys move from BDs to RIAs. And Jeff, how many have we helped in the last 5 years move from RIAs to go back to BDs?
None.
So, wirehouses and BDs, here's the thing. Here's why that's important. Do RIAs generally train new advisors? No. So, and wirehouses and BDs are finding it difficult to find new advisors, and they're losing the ones they train in the first 2 or 3 years. So guess what they're decided to start to do? Hire more or less and try to keep the ones they have. Because all they do is hire them, and then what do they do? What do the smart advisors do 2 or 3 years later? Leave. So then they're left with who? The same old advisors they had at the beginning. Or the ones that really, yeah, exactly. I won't say what Dave said, but not the cream of the crop. Because the good ones leave. So the second thing is the wealthiest generation in history is going to be passing 58 trillion in the decades to come. But there's an important thing that goes along with that. What's the important thing that goes along with that transfer of assets? See if anybody gets it. What's the important thing that goes along with that? Ah, Jerry's got it. Historically, according to Deloitte, 90% of wealth transfers from one generation to another have resulted in changing advisors. Yeah, Jonathan got it too. Bonnie got it too. Historically, 90% of them move to their different advisor. So if you're not working with children, guess what? You're going to not only lose clients, but you're not going to get those new the clients as they move. So, does 5Q help you retain clients when they move from one generation to another? So, Missy, can you get on the call a second?
Yep, I'm on.
When my clients died, who did the kids call?
Us, immediately.
Who did they call before the funeral of home? Who did they call before the accountant? Who did they call before everybody?
Yep, they called us. We were their first call.
Because guess what? What do you think their parents told them about us, guys? What do you think their parents told them about Kasnick and Clark? What do you think they told them? We did everything for them, right? They praised Jerry. So guess what? We retained those kids as clients because their parents said these are the people you need to work with. And you know why the kids knew that we were the people to work with? When their parents died, guess how many of the T's were crossed and the I's were dotted? All of them, because of the 21-point checklist. So are you guys being set up by being part of 5Q and using 21-point checklist to capitalize on this? Yes, because first of all, you're not going to lose clients because when we have that first hiccup and Jeff, when do we get all of the money managers flooding into 5Q? When the
market goes down.
Why? Because they've all told me that they have great relationships with their clients and they're not going to lose anybody.
Yeah, that all changes when they get their statements and they start to see that, You're losing them money, not making them money.
And when that happens, dudes, you're going to lose people. Also, when this money transfers from one generation to another, when all you are is a money manager, guess what the kids think? You're charging 2% between what you're charging and the money manager? Guess what I could do? I can do it for free. I can go to one of these robo-advisors. I can manage it myself. If you don't have some sort of relationship with those kids, dudes, you're in a world of hurt. And we've moved from the greatest generation to baby boomers. And how do baby boomers look at things? And this is a Deloitte Touche. I've been saying this for the last 5 years. Deloitte Touche is just backing me up. They're saying, listen, these investors are different than the ones you worked with 10 years ago. I am the most important thing. I expect to receive tailored advice, not cookie-cutter advice. I want you to understand what I'm doing. I want to understand what I'm doing. I'm not going to take your word for it because you're the expert. I better get what you're doing or I'm going to leave. I want to make important decisions for myself. Guys, so far, does 5Q do all these things? Do they understand what I'm doing? Who makes the decisions for them? Who makes the decisions for them? They do. I am skeptical of authority. Why don't we worry about that? Who's their authority? They are. And do they make, if you do it right, who's making the decision for them? Me or them? They're making it for themselves. And here's why that's just so important. They believe their peers more than experts. Guys, in the last election, all the experts, I think it was like 250 newspapers, editorial staff did not endorse Trump. 2 did. What did the people say to that? Yeah, the plumber was the expert, Dave. The plumber was the. So what, people believe experts or they believe their friends now? They're friends. But you know, there's only one person they believe more than their friends, and guess who that is? Yeah, Dave lives in a la-la land. He says they believe their spouse more than their friends. Who do they believe more than themselves? They believe themselves more than their friends. And what is the whole 5Q system designed around? Yeah, they come up with their own decisions. Investors have changed how they view risk. See, they used to view risk as volatility. Now, how do they view risk? They don't view it as volatility anymore. How do they view risk? Yep, Dave got it. Losing money. That's how they view risk. They no longer think, hey, when the market goes down, it'll come back. When they look at the market going down, they look at it as what? That money is gonzo. So those of you that are still, and is this me saying or Deloitte saying? Deloitte's saying it. Their research has showed that people no longer look at volatility. When we lose money, we get it back. They look at it when we lose money, we lose money. And how many money managers do you think are working under that premise? Or do they still look at it as a client thinking it's volatility? So when the market does have a hiccup, what are these money managers going to have a rude awakening to? That people no longer look at the down market as a volatility. They look at it as money that's gonzo. Why do they look at it that way? Because when we had the Great Recession, the last time we had a big market downturn, was there nearly a run on the bank? I myself had 500 grand in a money market fund, and guess what I found out about my money market fund? It was gone. My $500,000 was gone. Now, I sweated for 3 weeks before they finally decided to put that money back in there. But was there any guarantee they were going to do that? So guess what I think about losing money now? And I'm smarter than the average bear when it comes to this stuff. But does it matter whether you're smart or is money emotional? Other people's monies, I can be smart all day long. My own money, guess what? It's crazy emotional. And there's going to be a lot of people with a rude awakening that people's attitudes have changed about volatility. Volatility is not an up and down anymore. When the market goes down, they're looking at it being down. And what is the number one concern of the affluent? And really everyone else. What do you think the number one fluid? And you guys get this See, again, Dave, I knew Dave was going to say it. Dave said running out of money. That is 100% wrong for the affluent. Everybody's getting it now. Everybody's writing in lifestyle, lifestyle, lifestyle. That's what they're worried about. Am I really worried about running out of money, guys? You think I'm worried about running out of money? Me personally? No. But do you think I worry about my lifestyle? Yeah, I know I'll never run out of money. I know I'll never run out of money, but I might have to change my lifestyle. If the market starts collapsing and everybody, there's a lot of things that I have to that could affect my lifestyle. And here's the thing: even though I could lose a ton of money and it wouldn't affect my lifestyle, guess what still happens? I could lose a ton of money and it would not affect my lifestyle because I live a simple lifestyle, drive a Subaru, live in a normal house. And it's not that I just don't like it. What happens to my lifestyle when the market, if I lost a lot of money? Dudes, have you heard the true story about a guy who was worth $3 billion? He lost $2 billion. Guess what he did? He committed suicide. He still had $1 billion left. What did he think though when he lost $2 billion? Dude, when you lose money, I don't care what affects your lifestyle or not, it affects your lifestyle. So the affluent are concerned about making the most money in the world, or they're concerned about keeping their lifestyle? Keeping their lifestyle. That's what they're concerned about. Me saying it or Deloitte saying it? Deloitte. So giving them assurance is harder than it used to be. We have longer life expectancies. We have a rising cost of medical health care. Concern about insolvency of government programs, a difficult environment for investing. So giving them assurance of a great lifestyle is harder than it used to be. But guess what most Deloitte found most wealth managers were concentrating on? What do you think Deloitte found most returns, Dave? Exactly. Accumulation. Most wealth managers are on returns, 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 growth, growth, growth. And guess what they found that they should be concentrating on? Making sure their income does not change. Not that they have a great income. Making sure that the income they have now is what? Making sure the income they have now is what? Protected. And just protected at if they're making 100 grand now, so I make 100 grand now, or just if I make 100 grand now and inflation goes up 3%, then I make how much next year? 103. So Deloitte says making people the most money is not what they are worried about right now. They just want to make sure that the income they have now is what they have next year. So do they really care if their assets go from 4 million to 5 million? They'd like it. They'd like it, but if their assets went from 4 million to 5 million, but their income fell to from $100,000 to $50,000, would they be happy? No. See, we live in a commoditized business now. State of commoditization is reached when skills, services, and products are available easily. Guys, do you really have any skills, services, or products that other advisors don't have available to them? And are you in an area where there's no other advisors available? No. So, and the impact of commoditization is products, services, skills are no longer a differentiator. So can you say, my money manager is better? Can you say that any longer? See, seller can't then ask for premium rates. What is going to happen to asset management fees? So those of you counting your money with asset management fees, counting the money in your head on how much money you're going to make, guess what's going to happen to that in the coming years? It's going to go lower, and then it's going to go what? Lower. And has that happened in the last 5 years? Yes. And there's going to be cutthroat competition among sellers and lower margins on sales. See, Deloitte said advisors can no longer prove their services are differentiated based on their investment prowess. Guess how many advisors or money managers out there still trying to tell clients that they got a smarter advisor, that they got a smarter money manager? And what's Deloitte saying about that? Not good. So this is the Wall Street Journal saying what? 5-year, 10-year, 15-year percentage of equity funds that have outperformed the benchmark. What's it saying? Dudes, what have I told you about the people beating the market? So life is complicated. What are people looking for? Returns, or are they looking for a holistic report? So here's what advisors can do. Serve as a sounding board. Restate and play back arguments to sharpen the seeker's understanding of the situation and conclusions she has drawn. How can you do that? Asking a few well-chosen questions that probe the seeker's underlying rationale and motivation, and then listening attentively. Who does that? Hopefully, who does that? Hopefully, if you do what we train you to do you do that? Yes. Test the tentative path. Scrutinize the reasoning behind the selection of an option. In other words, scrutinize the reasoning behind the selection of their current advisor and elaborate on the potential consequences. Do we do this, guys? Assess the seeker's thinking, often using hypotheticals. I wonder why he did that. And critical questions to achieve a deeper understanding. Do we do this, guys? Expand the frame of reference. Provide greater breadth of understanding about the nature of the problem and the seeker faces, and the implications for actions. Share key details and tendencies from the prior experiences to similar situations to flesh out larger context. Do we do this? Provide process guidance. Suggest how to approach and manage a complicated, delicate, high-stakes situation. Do we do that with the sale? Do we do that with the FIA presentation? Generate substantive ideas. Increase the number and range of options being considered. Guys, for money managers that say stocks and bonds are the way to go, are we having them increase their range of options? So do we truly train you to be true advisors? And that's what Deloitte says, that if you're going to be a money manager because you're going to have them believe that you have the best way to invest their money, guess what's going to happen to that advisor? Instead, you need to be this advisor. And that's why you need to concentrate on what we're telling you to do. You go from the commodity, from being transactional. And guys, is money management transactional? Is money management transactional? Good, you guys are getting it, yes. So many guys, when they come onto the system, they think it's that money management is not transactional. It sure to hell is transactional, because all you're doing is what? What are you doing when you're doing money management? You're selling what? A thing. You're selling a thing. So you need to be diagnostic and consultative. Do we teach you how to do that? That's what's going to put you in the trusted advisor category. Advisors must find a way to broaden the advice they provide. Do we do that, guys? Despite these developments, a recent industry survey of Deloitte suggested that many advisors still face significant barriers to providing holistic advice to their clients. Instead, they found they're all doing what? Sell and return. But maybe your program is one of the few that avoids problems, not by using threads, but by processes. Do we do that with the 21-point checklist? We do that with motivational interviewing. Do we do that with the sale and the FIA presentation, guys? See, we're in the era of competitive convergence. How we obtain things. Is it easier or harder to obtain things for our clients than it used to be? How we buy things. Can we only buy things through people, or can we do it all online now? What we buy. Are people buying differently than they used to buy a long time ago when it comes to investments? How we pay, are they paying differently? Are they able to access it differently? How do they interact? Do they even need a human being to interact with anymore? How are they treated? How can they bypass friction? Guys, do you see what's happening to us? What's happening to each one of these boxes? Is it in our favor or the client's favor? These boxes. The clients. And are these boxes getting bigger and bigger every year, or smaller and smaller every year? So you need to be awesome at what we're teaching you. Because if you're not awesome at what we're teaching you and you continue to act like every other advisor out there, what's going to happen to your practice? It's going to shrink. See, we're competing against robo-advisors. We're competing against private banking. Private banking is now getting more and more. Private banking used to be for people who had lots of money. Is private banking for people with huge amounts of money anymore? Or are they going after the mainline affluent now? Regular banks are cross-selling, and banks and credit unions are cross-selling their investments. It used to be that you used to be able to, as an advisor, go to a credit union and pitch being their advisor. How often does that happen anymore? Or do they already have a department that does that? They're competing with us. the old competitors, BDs, insurance companies, discount brokers, and wirehouses, are they giving up or are they getting more aggressive? Well, some of the smaller BDs are giving up, but how about the insurance companies, discount brokers, and wirehouses? Are they getting giving up, or are they getting more aggressive with how they market and how they're going after clients? Are they looking at look at discount brokers? Charles Schwab, TD Ameritrade, they're getting more tentative, right? Or are they getting more aggressive with robo-advisors or human advisors, contact, etc.? Startups, and we don't even know what startups and private equity is going to do we? There could be more. Do you think that we've seen all the disruptors we're going to see in our industry? No, there's going to be more disruptors, and we don't even know what our next. And see, in order to stay ahead, you have one tool nobody else has, and what is that tool? All the advisors are not all. Huge chunks of advisors are retiring, and brokerage houses and BDs can't hire people fast enough. So we're going to have less advisors 5-10 years from now than we have right now, and there's huge amounts of money being transferred. But does that money being transferred necessarily have to go to any advisor, or are there going to be more and more people doing it themselves? More and more people using cheap alternatives. More and more people hiring robo-advisors. You think that's going to go up? Those low-cost, non-human being things are going to be going, more people using them or not? So you have a tool to keep those people under your umbrella. Because you know what people will pay for? What will people pay for? Value. That's right. Service, care, differentiation. What do we teach you to do? To be a great wealth manager? No, we teach you to provide value to your clients above and beyond rates of return. We teach you how to care about your clients above and beyond value or rates of return. We teach you how to be of good service and differentiate yourself from everybody else out there. So guys, please, please, please get serious about getting good at the scripts and the crib notes. The motive, your daily practice of your MIFT and your GOTS, your 5-minute money makers and tape breakdowns. When you do that, you'll bring on every single client. If I said, I'll pay you $1 million to learn to speak Spanish, how many of you would do that? If I told you I'll pay you $1 million to learn to speak Spanish, how many of you would do that? So I got 1 yes. Come on. Got 3. Come on, come on, come on. Got about 10. Come on. Really? The rest of you wouldn't do that? I'm getting a lot of does now. Yep. Si, senor. I got. So, guys, what are we teaching you with 5Q? Are we paying you $1 million, or could you potentially be making $1 million a year? What if you only made $500,000 a year for the rest of your career? How much money is that? If you do not learn to speak 5Q with motivational interviewing, with our scripts and crib notes, do you understand what Deloitte is saying that it's going to happen to your business? Now, is that going to happen overnight, or is that going to be a death of 1,000 cuts? And there's a danger in a death of 1,000 cuts, is that you don't even know that you're dying until what? The danger of a death of 1,000 cuts is you don't even know you're dying until it's too late. But if you're not doing what we're asking you to do with 5Q and learning the scripts and learning motivational interviewing and being on these calls and doing these things that we're asking you to get your skills better, that provide you your clients value and service and shows that you care and shows that you're different, that's what's going to happen. So please, dudes, you have an unbelievable opportunity in front of you. Capitalize on it. You could be putting your family, and your family's family in a situation that you'll never have to worry about anything again. And for the privilege of that, you're going to be helping people that nobody else is willing to help to the degree that you help them, okay? So take advantage of this thing. And I wish this was on the headlines every single day, but this is happening not in the headlines, it's happening underneath. But do you have any doubt that that Deloitte talked about in this disruption, do you have any doubt that this stuff is true? Capitalize on it, guys. Capitalize on it. We've given you all the tools to capitalize on it, okay? So you guys have a great rest of the week. I appreciate being on the call, and we'll talk to you all here next Monday, or I think Jeff will. Thanks, everybody.